Good morning, everyone. You are watching a live daily market outlook for Monday, 19th of March 2012, prepared by Windsor Brokers. The markets remain in the steady and I would say sideways movements during the Asian session, but some positive sentiment is seen in the global economy as it stepped back from the brink of danger, and signs of stabilization are emerging from the Eurozone and the United States. However, still high debt levels in developed markets are and rising oil prices are key risks ahead. This was the comment of IMF from yesterday, and they said that the global economy might be on a path to recovery, but there is not a great deal of room for maneuver and no room for policy mistakes. In a separate talk on the same day, Christine Lagarde, the IMF managing director, said that China yuan could become a reserve currency in the future, adding that the country needed a roadmap for a stronger, more flexible exchange rate system. She said signs of stabilization were emerging to show that policy actions taken in the wake of a global financial crisis were paying off, that U.S. economic indicators were looking a little more upbeat, and that Europe had taken an important step forward in solving its crisis with the latest efforts on Greece. Also from states, for the third year in a row, optimism is spreading that growth in the United States could be poised to accelerate and drive the economy into sunnier areas. Claims for the first time jobless benefits dipped to a 4-year low last week as layoffs slow. Factory output is steadily expanding. Retail sales have picked up the past 2 months, and Europe no longer looms as an immediate threat since Greece restructured its debt and won more bailout money. Even a 9% surge in gasoline prices on tensions with Iran over its nuclear program has failed to take much shine of consumer confidence. University of Michigan survey slipped by 1 point to 74.3 in early March, but views on current conditions edged upward. That is a market improvement from 5 months ago, when the prospect of a Greek sovereign chaotic default loomed large, and running battles over the U.S. budget deficit damaged the business and consumer confidence. Economists last October put the risk of the United States sliding back into recession at 30%. But these days no one is talking about recession. The talk now is more about sustainable recovery, and investors are betting the world economy has turned the corner. The investors also poured into stocks last week, shedding safe haven U.S. and German government debt, and the VIX, an index that tracks U.S. Stock market volatility, and is now, as Wall Street's fear goes, hit its lowest level since the summer of 2007, when the financial crisis began. All things are considered, and the former Federal Reserve Chairman Paul Volcker said he thinks that we are doing pretty well, and the further recovery is on the way. As mentioned, today is Monday, the beginning of the week, and usually calendar is quite poor. No significant releases except today's, except few things, which is the Eurozone the current account that is due at 9 o'clock GMT, and the 3.3 billion euros positive balance is expected for today, compared to the also surplus of 2 billion euros of the previous month. And also from Canada, there are wholesale sales at 12:30 GMT. 0.4% increase is seen for today, compared to increase of 0.9% previous month. Also from U.S. housing market index due at 1400. slight improvement for today, forecasted 30 versus 29 of the previous month. We're going to take a look now at the markets and see the latest movements in past 24 hours or so. The euro is in the recovery mode of 130.00, last week's low, as the pair broke initial barriers at 131, 131.20, extending so far to 131.90 zone. Where is the previous high of 13th of March, also 38.2 Fibonacci retracement of the down move, the latest easing of 134.85, double top of end of February. The recovery now leads to clear 131.90, 132.00 in order to resume higher, as the near-term studies are still positive. For our outlook is still holding positive. However, current pullback on the hourly is already affecting the structure, as it started pointing lower in the immediate break below support at 131.50, whereas 20 days exponential moving average now looks for test of the next significant support at 131.20, previous resistance, where is also the previous high, and also 55 days moving average. Loss of this level would weaken the current structure and the open way for a further easing with 131.00 and 130.50, the strong support seen on the break. Reversal above 131.00, 131.20 would keep the short-term uptrend of 130.00 in play. With break above 132.00 to open way towards next very significant and strong barrier at 131.90 previous, 132.90 previous high of 8th of March, and 133.00, 61.8 percent Fibonacci retracement. As mentioned, the overnight's quite dead market, I would say, as the pair moved in within a very narrow range and the sideways mode. Now got some more action during the early European hours with the negative outlook currently, as the pair is in the corrective pullback. This is due to overbought conditions on the hourly charts. As hourly studies are still holding in the positive territory, we see potential of reversal above 131, 131.20, which would be ideal for the pair to keep the current positive structure and the open way for further recovery of the broader downtrend of 134.85. Only loss of 130.50 would negate the current bulls, and the open way for 130 and the possible extension of the broader downtrend towards next strong support at 129.73, a higher low of 16th of February 2012. The cable recovered a good part of its recent losses, as the bounce of 156 base hit on 12th of March broke some significant levels. First was 157.50 previous high and 38.2 Fibonacci retracement, 158 50% retracement, and the more significant is 158.32 previous top, where the prices were capped before the significant slide lower. Also there is 158.42, 61.8 Fibonacci retracement that was cleared, with the price action extending so far to 158.60, just ahead of 158.81 and next static resistance. Currently the pair is in the corrective consolidative mode, I would say, moving still within a narrow range, with immediate support at 158.20 zone, which is the low of the range, and the 20 days exponential moving average, while further supports lie at a significant one is at 157.65, where is 55 days exponential moving average, and 157.50 the previous range ceiling, above which the ideally reversal should occur in order to resume the current recovery. A break above 158.60, 158.80 is to focus again levels at 159 and possible test of 159.91, 160 previous highs. On the downside, loss of 151.50 would weaken the current structure. However, the 4-hour studies are positive, but a bit overextended, so we might see some corrective action before the pair finds a new bottom and resumes the broader uptrend. Only loss of 157 would be risky, as this will put aside again near-term bulls and open way for further easing towards 156.40 and the possible extension to 156.00 seen on a break. The dollar yen is still in the corrective mode after the consolidating losses at floor at 83.20. That was the reversal of 84.17, last week's fresh 11-month high. This morning has seen more action as the pair broke below, currently testing 83.00, and the possible further and stronger corrective action is seen ahead, as the 4-hour studies are still in the positive territory but pointing lower, while the hourly studies broke below their midlines and broke below moving averages, signaling further extension 82.80 after break of 83.00 to open 82.80, Fibonacci 38.2% ahead of 82.63 previous high of 9th of March, and 82.37, 50% retracement. At this point, close to this is also 55 days moving average. Only loss of 82 handle, which is the previous low, and close to 61.8 Fibonacci retracement would delay immediate bulls in favor of stronger reversal, as daily studies are at their extremes, and some signals are seen now of a stronger correction of the broader and strong uptrend from 76 beginning of February base. Otherwise, higher low above any levels above 82.00 would keep the immediate structure positive, and the possible extension above 84.17 to open way for test of our key short-term target and barrier at 82.85, 30.50 zone, where we have a 50% retracement, 150 days moving average, and the previous peak high of 2011 at 85.51. The dollar Swiss's recent rally seems to be losing traction. The bounce of 89.30 double bottom has so far reached 93.33 high, and since then is in the corrective movement, currently holding above recent base at 91.50, where the pair found temporary support. The near-term studies are in the negative territory, and still keep the downside is in focus, as the pair stopped its descent just ahead of 91.30-40 zone, where is the previous low, and 50% retracement. Current bounce higher is seen corrective, as long as holding below 92.50 zone. So initial the dynamic barrier at 91.72 is now under pressure ahead of static resistance at 92.00, where is also 55 days exponential moving average, and break here to allow for test of 92.50. As mentioned, only above 92.50 would turn the focus higher. Otherwise, there is a risk of lower top and fresh extension lower, with initial targets at 91.50, 91.30 zone, ahead of more significant at 90.86, 61.8%, and the higher low of 8th of March at 90.69. Daily structure on dollar Swiss, as the studies briefly broke above their midlines, but it seems to be still fragile, and we need to see the break a minimum above 92.50, where is the 90 days moving average on the daily chart, in order to confirm the positive structure of 89.30 double bottom and open way for a stronger recovery. Otherwise, risk is seen on a test of previously mentioned lower levels at 91.40 and possible extension towards 90.70. The gold ticked higher following crude oil, as the recent recovery of last week's low at 16.34 reached the highest at 16.66, where the 4-hour 20 days exponential moving average so far capped the gains, and this is just around the previous low at 16.63. So this break point is currently holding recovery attempts capped, and the most likely scenario would be further easing, as the studies on the 4-hour chart are still in the negative territory and still pointing lower. However, some extended conditions see potential of a possible further extension. Hourly studies are positive to neutral, but we need to see the break above minimum 1666, the range ceiling, in order to pick up the latest recovery. The Fibonacci levels of the latest down move from 1716 to 1634 are offering resistance at 1675 and 1685, 50 and 61.8%, and the break above 1685 is to focus 1700 as a psychological barrier, and more significant 1716 and the key barrier at 1725, above which is break above which is required to signal some stronger recovery. Otherwise, risk is seen on the lower top, and possible extension lower, as the daily studies are into negative territory and keep the focus on the downside, as the pair lost the main bull trend line as well as 200 days moving average, and so far holding below these levels keeps the focus on the downside, with loss of the latest low at 1634 to open 1625, which is the next Fibonacci level at of 61.8% ahead of static support at 1604 and 1600 as the round figure and psychological support. The crude oil, just to turn it to the May. Okay, the daily outlook for crude oil remains positive, regaining momentum again after finding a base at above $104 per barrel and just above the main bull trend line at 103.60. That keeps the focus higher. On the lower time frames, the price action of last week's low at 104.29, pardon, was so far limited on approach to 108.00. Our initial barrier as 108.0020 offers initial resistance, and a brief pullback was seen in the early hours of European session, weakening the current hourly structure. Initial support static at 106.67. 107.00 is now under pressure as the figure support, and then 106.67 ahead of next one at 105.64, low of 16th of March 2012. Loss of this level is to refocus 104.29, which is our key short-term support. As shown on the larger time frames, the oil price is still within the range, trading and moving sideways after hitting a fresh high at 110.53 at the beginning of March. Basically, break below a range at 104.30 zone would signal some further weakness and further reversal of the recent peak, while break above 108.20 to give the upside, fresh upside direction towards 109 and 110 levels. However, as mentioned, the daily structure is still more positive, but it seems to be losing, the study seems to be losing traction. We need to see clear break above 108.20 in order to improve and turn signals more positive and more strong, actually, to focus levels at 109 and 110, as the broader uptrend for the crude oil remains still intact. Have a nice day.